Most people think family offices are only for billionaires. That belief exists because traditional advisors benefit from keeping it that way. After watching this, I guarantee you will think differently about how wealth is actually managed once income and complexity rise, and why most so-called good advice quietly stops working for the wealthy. This is not about being ultra-rich. It's about not being trapped in retail financial advice long after you outgrow it. If you are making strong money and your plan still looks like, hey, max out your retirement accounts, buy index funds, rebalance once a year, you are no longer being advised, you are being managed for convenience. That playbook is designed to reduce mistakes and scale easily for the advisor. It is not designed to minimize your taxes. It is not designed to produce cash flow. It is not designed to integrate private investments or real assets into your portfolio. Most advisors never change the framework. They just repeat the same advice with more confidence as your numbers and their fees get bigger. There's a different way to think about this, and it starts with treating your finances like an operating system, not like a collection of retirement accounts. A family office is not a building, a staff, or a trust structure. A family office is simply running your personal balance sheet like a business. Instead of asking, what should I invest in? You ask three better questions. How should my capital be deployed to maximize returns relative to risk? How should cash flow be generated? And how should taxes be actively managed across my entire portfolio? That is it. You do not need new entities to start. You just need a system that coordinates investments, taxes, and liquidity instead of treating each decision in isolation. This approach starts to matter when one of three things happens. 1, your income is high and consistent. 2, your tax bill feels aggressive every year. Or 3, you have excess capital with no clear priorities for it. If none of this applies, then sure, keep it simple. Just keep buying ETFs, averaging into the market, and continue as is. However, if your financial life has gotten more complicated with larger numbers, keeping to that boring advice can get expensive very fast. And so what should you do instead? Step 1, you should focus on after-tax cash flow. Retail advisors focus on accounts. Family offices start thinking about outcomes. So the real question is not a Roth versus a traditional IRA. Instead, it's what does this dollar produce after tax over time in real tangible wealth and income for our family? Because high-income families lose the most money in three places. They might be paying unnecessary ordinary income tax, they might be holding growth assets in inefficient structures, and they're likely ignoring cash flow planning entirely. This is where alternative investments can come in. Private equity, real estate, private credit, and other tax-advantaged strategies are not about status. They're not about access. The rich are not investing in these asset classes just because they can. Alternative investments are about solving problems that public markets and retirement accounts do not solve well. Predictable income that doesn't require you to sell your principal, tax deferral, and the potential for higher returns with lower volatility, aka a smoother ride. This is where most traditional advisors struggle because it requires expertise in evaluating private market strategies, understanding which advanced tax strategies are appropriate, while being comfortable advising on client assets outside of cookie-cutter ETF portfolios. All right, a simple family office decision process. This is a big step into running your portfolio like a business. Now, before capital goes anywhere, family offices ask three questions. 1, what role does this capital play right now, and what returns do we need for it? 2, what risks are acceptable for this capital? 3, what does it do to my tax liabilities now and into the future? This process reduces regret, which is entirely the point. And so when this structure is implemented, your investment choices change naturally. You rely less on public markets for everything. You start to use private credit and real assets for income. You might look at private equity intentionally, ideally in a tax-efficient account, and you probably start thinking about after-tax returns and not just IRRs. So this doesn't have to be exotic. It just has to structure your portfolio where the capital is matched to your goals and the taxes are planned in advance. Therefore, the cash flow is treated as a primary driver of your wealth. It's not treated as a nice little bonus, a small dividend here or there that you're getting from your stock portfolio. It's treated as the actual driver of wealth because family offices, they don't sell stock to fund their lifestyles. They let the principal compound while funding their lifestyle and their legacy goals off the actual cash flow distributions from their investments. Okay, so why do most advisors not operate this way? Most advisors are fine people. They just have the wrong incentives. Traditional advisors are rewarded for simplicity, scalability, and asset gathering. Despite what they say, they really want to be McDonald's. They want to deliver the same product cheaply, the same way every single time. Whereas family office thinking requires custom coordination, tax efficiency, and unique asset selection. Those goals do not align well with the financial advisor traditional business model because alternative investments require more explanation. Tax planning requires collaboration with your CPA. Cash flow planning reduces dependence on products. So it gets labeled as complex or only for the ultra wealthy. Of course, neither is true. It just does not scale cleanly, so most clients never hear about it. Once again, you do not need billions to invest like a wealthy family. You need to stop treating taxes as an afterthought, expand your portfolio to include alternative assets, and start building a coordinated system. If you feel that you have outgrown retail advice, this channel is for that exact scenario. So if you want help building this, reach out to our firm. Resources are below. Thanks for watching.